$4,700 every single year. And most retired Americans have absolutely no idea this money is leaving their pocket permanently. If you are over 70 years old, listen to what I am about to say very carefully. This is not about some complicated investment strategy. This is not about moving money around or taking on risk. This is about deductions that already belong to you. The IRS has written them into the law. They are sitting there right now waiting to be claimed. But because nobody sat down with you and walked through your specific situation, year after year, you file your return and you leave that money behind. You hand it to the government voluntarily. And the worst part is, you do not even know you are doing it. That stops today. Here is what actually happens when you do not claim every deduction that belongs to you. The IRS is not going to call you and say, "Hey, you left some money on the table, let us fix that for you." That is not how this works. By law, the IRS is required to collect what you owe. It is not required to protect what you keep. That distinction matters enormously. If you overpay, that is your problem, not theirs. Now here is where it gets serious. If you are over 70 and you have a traditional IRA or a traditional 401k, the IRS requires you to take money out every year. This is called a required minimum distribution, or RMD. The rule lives inside IRS publication 590-B. If you miss that withdrawal or take out too little, the IRS can legally charge you a penalty of up to 25% of the amount you should have taken out. That is not a typo. 25 cents on every dollar you were supposed to withdraw. And if you are paying that penalty while also missing legal deductions, you are getting hit twice from both directions at once. On top of that, if your combined income crosses certain thresholds, up to 85% of your Social Security benefit becomes taxable income under IRS rules tied to what they call combined income. This is not a small adjustment. For many retirees, this means thousands of dollars in additional federal taxes every single year. All of this is happening legally, inside the tax code, and most people never see it coming until it already hit them. Most people do not know this because the tax code was not written for regular people. It was written by and for people who spend their careers studying it. The IRS publishes over 10,000 pages of rules, instructions, and publications every year. Nobody reads all of that. Not even most accountants read all of it. They specialize. And if your accountant specializes in small business deductions or corporate filings, the specific rules that apply to retirees over 70 may not be at the top of their mind when they are rushing through returns in March and April. Here's the forbidden knowledge part. The IRS has what is called a higher standard deduction for people over 65. It goes up again after 70. It goes up differently based on whether you are single, married, or widowed. Most software just plugs in your age and moves on. But the rules around stacking that deduction with other retirement-specific deductions, that is where the real savings live, and that is what most advisors never explain. There is also this. Many retirees have medical expenses that are genuinely enormous. We are talking about Medicare premiums, supplemental insurance, dental work, hearing aids, prescription costs. Under IRS rules tied to Schedule A, you can deduct medical expenses that exceed 7.5% of your adjusted gross income. For a retiree bringing in $40,000 a year, that threshold is $3,000. Every dollar of medical expense above that $3,000 line is legally deductible. And yet most people never take it because they assume it will not add up, or because their tax software breezes past it, or because nobody ever explained the rule to them clearly. And then there are the charitable deductions for people over 70 and a half. This is one of the most powerful tools in the entire tax code for retirees with IRAs. It is called the Qualified Charitable Distribution, or QCD. Most people have never heard of it. Their financial advisor has heard of it. But did that advisor sit down and explain it to you in plain language with real numbers? They will not tell you this in a generic newsletter. This is the kind of thing that saves thousands of dollars for people who know it exists. This information is not secret, but it is buried, and the people who know it are not typically shouting it from rooftops. That is what this channel is for. Here is the first deduction. It is called the Additional Standard Deduction for people over 65. Here is the specific fact. If you are 65 or older and filing as a single person for the 2024 tax year, you get an extra $1,850 added to your base standard deduction. If you are married filing jointly and both spouses are over 65, you get an extra $3,000 added on top of the base deduction. If you are widowed and filing as qualifying surviving spouse, the rules shift slightly but remain very favorable. This is written into IRS Publication 501, and it applies automatically if you claim it. Here is a concrete dollar example. A single retiree age 72 takes the standard deduction. The base standard deduction for 2024 is $14,600. Add the extra $1,850 for being over 65, and that person is now shielding $16,450 of income from federal taxes. At a 15% tax bracket, that extra deduction alone saves $277 every single year. That is money you keep, legally, just by checking the right box on Form 1040. What to do? When you file your 1040, look at the section titled Standard Deduction. There is a checkbox that asks if you are 65 or older. Check that box. It sounds almost too simple, but the IRS estimates millions of eligible filers miss this adjustment every year. If you use a tax preparer, ask them directly, "Are you applying my age-based standard deduction adjustment?" Make them confirm it out loud. Here is the second deduction. This is the one that most people write off before they even calculate it. The specific fact is this: under IRS Schedule A, you can deduct out-of-pocket medical and dental expenses that exceed 7.5% of your adjusted gross income. This threshold used to be 10%. Congress lowered it permanently to 7.5%, and that change is in your favor. Here is a concrete dollar example. Your adjusted gross income is $50,000 for the year. 7.5% of $50,000 is $3,750. That is your threshold. Now add up what you actually paid. Medicare Part B premiums, which are automatically deducted from Social Security. Medicare Part D premiums. Supplemental insurance like Medigap. Dental care, vision care, hearing aids, prescription copays, transportation to medical appointments. If those costs total $9,000 for the year, then your deductible medical expense is $9,000 minus $3,750, which equals $5,250. At a 22% tax bracket, that single deduction saves you $1,155. That is real money. What to do? Start keeping a medical expense log right now. Do not wait until tax season. Every time you pay a premium, a copay, a dental bill, a pharmacy receipt, write it down or put it in a folder. Then when you sit down to file, add it all up before you decide whether to itemize or take the standard deduction. Compare your itemized total to your standard deduction amount. Take whichever one is larger. This changes everything for retirees with high medical costs, because you only need your total itemized deductions to beat your standard deduction by $1 for it to be worth it. Here is the third and fourth deduction, and I am combining them because they work together. The specific fact is this: if you are 70 and a half years old or older, you are allowed by law to transfer up to $105,000 per year directly from your IRA to a qualified charity. This is called a Qualified Charitable Distribution, or QCD. The money goes straight from the IRA custodian to the charity. It never touches your bank account. And here is why this changes everything. That distribution is completely excluded from your taxable income. Here is a concrete dollar example. You are required to take a minimum distribution of $8,000 from your IRA this year. If you take that distribution as cash, it gets added to your income, possibly pushing your Social Security benefit into taxable territory, possibly bumping you into a higher Medicare premium bracket. Those IRMA surcharges, income-related monthly adjustment amounts, can add hundreds of dollars per month to your Medicare costs. But if you direct that $8,000 as a QCD to a charity you already support, it satisfies your RMD requirement, and it does not touch your taxable income at all. You lose nothing. You gain a significant tax shield. And here is the fourth deduction tied directly to this. Because the QCD lowers your adjusted gross income, it may push your combined income below the Social Security taxation threshold. That could reduce or eliminate the portion of your Social Security benefit that is taxable. Two tax advantages from one move. Most people never use this because they do not know it exists. What to do? Call your IRA custodian before December 31st. Do not wait until January. Tell them you want to make a qualified charitable distribution. They will ask for the name and mailing address of your chosen charity and the amount. The charity must be a qualifying 501c3 organization under IRS rules. The distribution must go directly from the custodian to the charity. It cannot go through your hands first. The IRS tracks this on Form 1099-R, and it must be reported correctly on your 1040. If your tax preparer does not ask you about this, bring it up yourself. Here's what you need to do before it is too late. Step 1. Pull out your most recent federal tax return right now. Find Form 1040, line 12. Look at the standard deduction amount that was applied. Now check whether your preparer included the additional standard deduction for your age. It is listed just below line 12 in a checkbox section. If those boxes were not checked, you may need to file an amended return using Form 1040X. The statute of limitations for claiming a refund is 3 years from the original filing deadline. That means you could still claim money from prior years. Step 2. Before January 1st of each tax year, total your annual medical expenses. Do this before you file, not after. Compare that itemized total to your standard deduction. If itemizing beats the standard deduction, use Schedule A and take the medical expense deduction. If it does not, take the standard deduction. But you have to calculate it first. Guessing costs you money. Step 3. If you are 70 and a half or older and you have a traditional IRA, decide now whether to make a qualified charitable distribution before December 31st. The deadline for a QCD to count toward the current tax year is the last business day of December. Contact your IRA custodian directly. Give them enough time to process the paperwork. Some custodians need 2 weeks or more. Step 4. If you have significant medical deductions and are close to the standard deduction threshold, consider bunching your medical expenses. If you can schedule elective procedures or pay ahead on premiums in a single tax year, you may push your medical total high enough to cross the itemization threshold and unlock a deduction you would not have had if those costs were spread across 2 years. Step 5. Check your combined income number. This is Social Security wages plus your adjusted gross income plus tax-exempt interest. If that number sits between $25,000 and $34,000 for a single filer, up to 50% of your Social Security benefit is taxable. Above $34,000, up to 85% becomes taxable. If your QCD or other deductions can bring your combined income below those thresholds, you could reduce the tax on your Social Security benefit significantly. Ask your tax preparer to run both scenarios and show you the difference. If you found this useful, subscribe. Every week I cover what the IRS expects from retirees, the rules most advisors never explain. This channel exists because the tax code has real advantages built in for people over 65 and over 70, and the people who benefit most are the ones who know what to look for. Hit subscribe, turn on notifications, and share this video with someone you know who is retired. The information is free, the savings are real.